I wish I knew what a tax wrapper was, but I'm too embarrassed to ask. You'll sometimes hear people ask, should I invest in a private pension? Indeed, a question often put to celebrities in Sunday newspaper personal finance supplements is, do you put your money into property or a pension? As if the two are mutually exclusive. However, it's important to understand that, unlike a buy-to-let property, a pension is not an investment itself. A pension is simply a container into which you put investments. These investments might include individual shares or bonds, funds and investment trusts, commercial property, and even cash. The pension container, or tax wrapper, as the financial industry likes to call it, protects your investments from tax. A pension is one of the best known types of tax wrapper. When you invest money using a pension, the government tops up your contributions on the way in. While investments are in the pension, they can grow tax-free. Then, when you come to retire, any money you take out is taxed, although often at a lower rate than during your working life. An ISA, or individual savings account, is another well-known type of tax wrapper. On a traditional ISA, you don't get any tax relief when you pay into it, but as with a pension, investments within the ISA can grow tax-free, and unlike a pension, any money you take out is free of tax. More specialised tax wrappers include venture capital trusts and enterprise investment schemes, which offer wealthier investors tax breaks in exchange for putting their money into riskier small companies. Why do governments offer these tax breaks? It's mostly to encourage us to save for our old age, so that we don't end up being a burden on the state. That said, the rules governing tax wrappers have constantly been tinkered with by successive governments, so it's always worth keeping an eye on the latest developments, which, incidentally, is another good reason to subscribe to MoneyWeek magazine.